Welcome back. Today I will talk about invested capital, which is needed to understand profitability, which we measure using the return on invested capital, or ROIC in short. So in terms of process, so what are we doing? So the first thing we always do is we focus on financial statements because, well, this is what we know outside in about the company. As highlighted before when we spoke about NOPLAT, we have to understand actually what is operating and what is non-operating. Because end of the day, our focus is not on the accounting performance, or put differently, what companies want us to believe. It's about the economic performance. This is what we try to understand. From this work, which is focused on the income statement for NOPLAT and on the balance sheet for invested capital, we can bring these two together to understand profitability. Profitability is measured using the return on invested capital. So what we do is we take our NOPLAT, so the money we make from our operation, and we divide by the money we need to run the business, which is the invested capital. And this is our core value driver. And if you go back to the first unit, the main issue with value creation is not just to turn a profit. The main driver is to make sure that your profitability exceeds the expectations, or, as we put it, the cost of capital. So to make money, we have to ensure that return on invested capital exceeds cost of capital. That's the key for value creation. So you have to deliver more than expected by your investors. And then finally, we of course have to look at how you grow the business. And there are different ways of doing this, and we will go deeper into these different aspects. So one could be organic, so you just add, for instance, new products, or you grow from existing products. One could be bought in business, so acquisitions. Then of course you also have changes in accounting settings and standards, and also of course currency fluctuations that have an impact on the business. Of course, these again are non-operating. Yeah, so again we have to understand actually what is coming from your business decisions and what is just driven by market forces out of your control. So fundamentally, this is what we do. We look at profitability, we measure it using return on invested capital, we look at the money you make using our NOPLAT measure, the net operating profit less adjusted taxes. We divide by the money you need to invest in your business, the invested capital. So that's our core value driver. Now, in terms of the work you have to do as a financial analyst, before you actually do any financial modeling, you now have to explore the balance sheet, and you have to see what is driven by operations, what is driven by other factors which are not really part of your operations. We already talked about the left-hand side, the NOPLAT. We already have done the adjustments for that. And now in the case of invested capital, we do something similar on the balance sheet. We have to understand, of course, our asset structure. So some of the assets will be operating, some will be non-operating. Yeah, non-operating assets, for instance, include financial assets, which are just used to store value over longer time periods. And again, we talk here about non-banks when we analyze invested capital, because it doesn't make much sense for banks to do that. We have two different types of working capital which we have to consider here. We have our own corporate cash holding, and then we have working capital coming out of your operations running the business, and we come and talk about this in a minute. Corporate cash holding can be sometimes non-operating. This is something I just want to highlight here, because some companies hold a lot more cash than they actually need to run the business, and in this case part of your cash holding could be then classified as financial asset. So that's a complexity we have to have in mind. In terms of assets that are operating, we have the short-term assets that belong into working capital, and we have long-term assets like property, plant and equipment that go into long-term fixed assets that are operating. And then there are certain items that are a little bit more difficult to understand. One of these items is goodwill. Sometimes it could be seen as part of your operations, and sometimes it's taken out of the calculation of invested capital. But we talk about this in a minute in more detail. So here again we have an example which highlights what you're supposed to do. So whenever you look at a balance sheet, there are certain items that immediately kind of give you a sense this is core operations. Now looking here at the asset and liability structure, you have for instance a factory. Yeah, a factory is an operating fixed asset, so this would be classified as net property, plant and equipment, so that would be operating. Your inventory again would be operating. Then you might have financial assets. Financial assets are usually non-operating, except there are aspects here like operating cash holding that might be required to run the business, but actually we talk about this in a minute. Only a small number is needed nowadays to run a business in a developed market. Then you have accounts receivable. This is part of working capital. So accounts receivable occur when customers are supposed to pay for a service or a product that they haven't done so. Yeah. So this is money you would expect from customers. Then on the liability side, you have your debt and equity, and we will talk about this a lot more in following sessions. And we have accounts payable. Now accounts payable or trade credit, this is money which you owe to suppliers. Yeah, so that's a liability. You have to in future address that, but yeah, you are at the moment not meeting these obligations. Yeah, so again, this happens in normal trading activity. You get a delivery, and you might have a few days to pay for it, and then it emerges as accounts payable on your liability side. Again, this is short-term liability. It's part of your working capital. So working capital is focusing on your current assets and current liabilities, and long-term operating items are classified mostly under net property, plant and equipment. Sometimes you might have additional items on the balance sheet that have to be investigated. Now, to understand operating working capital, we already highlighted a few of these items. So we have accounts receivable. So again, these are payments expected from customers. They are usually classified as net receivables because you might make some adjustments to it, depending on, for instance, whether you expect payments, or sometimes also companies might sell off accounts receivable, for instance. So there are lots of things you might need to consider. But we just take what is provided, of course, in the balance sheet and investigate that further. Then we have inventory or stock. So again, that's operating. It's a current asset, short term. Then we have accounts payable or trade credit. So this is money you owe. And then we have potentially what you call operating cash. Now, there is a general rule which we applied when I worked as an equity analyst. We took 2% of revenues as the operating cash. Now, what's the logic behind that? The idea is, depending on the size of your business measured by revenue, you might need a small fraction of it as cash in hand to do the business. Of course, the 2% is kind of really a little bit random. It's based on some empirical work that was done in many industries. So usually it is somewhere in this region of 2%, sometimes a bit higher. You might consider sometimes to adjust this measure and to go to higher values. For instance, once I analyzed a casino in Austria, and in this case we argued that maybe 2% is not plausible because they do handle a lot of cash. So in this case we went up to 10% because they had a significant cash holding. And of course, it depends on the country context. But in most cases, I would say 2% of revenue is a good measure. So if a company has more cash holding, so more cash and cash equivalents compared to 2% of revenue, you would call this excess cash, and it would be classified as a financial asset. So that's basically what we are doing. So in total, we have the net operating working capital, as this depicted here. We have operating cash, we have added accounts payable as well, we have the inventory added to it. So these are all the current assets minus current liabilities. Yeah, so, and sometimes you might have other items as well, sometimes classified as other current assets or other current liabilities, which you might need to consider. When it comes to financing of working capital, so many businesses resort to short-term debt to finance working capital. So you might have lines of credit, for instance, which gives you flexibility for short-term funding, but also companies use their corporate cash holding as a buffer as well if there's some short-term financing needs. And it depends very much on the size of a business. So for very large companies, you have other means of financing. Yeah. So that of course makes a difference. So in many small companies, you see because of that a little bit more corporate cash holding. So that would be quite expected. So for instance, for large organizations, you might have commercial papers, which is short-term funding, only usually for a few weeks to cover short-term financial obligations. Now there are other operating fixed assets, which we classify under net property, plant and equipment. So like, factories, things you need to run the business. Sometimes you also have an item which is called other assets, and then you have to check in the notes whether this is operating or not. Now there is a lot of discussion around intangible assets, so I would usually look at this in more detail and think about actually what is behind it. So very often, for instance, if you look at a service company like a software company, you might have significant intangible assets. It could be also driven by certain business activities, and we have to explore this further. Now, goodwill is another component which I would consider, and sometimes I would report figures including and excluding goodwill. So the main driver of goodwill is mergers and acquisitions. Yeah, so whenever you purchase a target firm, and the price you pay for the target is higher than the net assets. The net assets are all the assets you acquire minus the liabilities. So for instance, after paying off the debt, you get the net assets of a target firm, and usually the price you pay is higher than that, because it's not only the assets and liabilities you want to acquire, you also want to acquire, for instance, the customer base or a certain product innovation or anything else you think it's worth acquiring. So this difference is then recorded as a goodwill on your balance sheet. And again, I might explore this further when we talk about mergers and acquisitions.